Do you understand amortization? To me, it's one of my most favorite topics that I truly understand, and a lot of people don't. And it has a dramatic effect on your cost of home ownership. So let's get into it. What is amortization? That is the systematic process of making payments to pay off a obligation or a debt. So let's say you start at 600,000. You make a monthly mortgage payment that is consisted of a principal amount and an interest amount that then systematically pays off the mortgage over a 30-year period of time. Every time you make a principal payment, you owe a little bit less, thereby pay more of the principal off, gaining equity, and your interest gets a little bit less also. Everyone will say you pay more interest in the earlier years of a loan. I want you to truly listen to this. It's a discussion that people do not talk about. With a lower interest rate, you pay more to principal in the earlier years of the loan also. And that is a key point of why people should, one, shop on a purchase to get a lower rate, two, learn and master the no cost refi. So I'm going to get into a couple of those topics and why. So let's look at my spreadsheet that I designed and have been using for over 28 years. This spreadsheet has made me a lot of money and helped me educate a lot of consumers. So here on an $800,000 loan, 6 3/4, the monthly payment is $51.88. Let's look at the breakout of that. The very first payment, $688.78 goes to principal. $4,500 goes to interest. Once you make one payment, you now owe $799,311. That carries over to the second payment beginning balance. And the process just keeps going back and forth. And each month, the very second month, you paid a little bit more to principal, $692. So less than $4, but you also paid $4 less in interest. So this shows you how those two ebb and flow. Interest goes down, principal goes up each time over 30 years. But here's the thing that people don't truly understand. If you can get a lower interest rate, let's say 1/4% versus 6.5 versus 6 3/4, the mortgage payment difference on a monthly basis is $132. Let's do some simple math. If you took 800,000 times 0.0025, the yearly savings should be $2,000. If you divide that by 12, it's $166 difference for a 1/4% lower rate on a monthly basis. But you say, Kevin, but my payment only dropped 132. That's right. That's where the magic happens. Where's the other money? Look on this spreadsheet as I designed it. The difference in the very first payment is $34.43. More additional payment if you were comparing 6 3/4 on a purchase versus 6.5. So here's the thing. Let's look at that. The very first payment at 6.5, you would pay $723 to principal, thereby owing less and saving more money. So here's the thing, and here's what people don't understand. If I asked even loan officers how much the savings would be on a mortgage over a 30-year time frame, most people are going to take the $132 multiply it by 360, and they're going to say $47,606 is the savings. That's not the right answer. It's double that. And let me show you why. What happens is that additional principal balance compounds. So you're paying off in the earlier years of the loan more the principal than you would at the higher interest rate. So that additional 30 some dollars is a snowball effect and actually compounds to be a greater number. Simple interest, 2,000 times 30 years is 60 grand. But here's the thing. When that is compounding over a 30-year period, the interest savings, when you look at 6.5, is $1,067,000 in interest versus $1,020,000. You actually save the same amount of money, $47,606 in interest, thereby saving $95,213 for a 0.25% difference on $800,000. That is why when you take the recommendation of just your real estate agent, call my loan officer, and don't check with another loan officer. There was a study Federal Reserve did that by checking with one additional loan officer, you on average would save 0.28% in rate up to 0.55 just by checking with one additional loan officer. So the key is shopping just a little bit. Sounds like, oh, a quarter isn't that much. It's $95,000 over the life of this loan. Here's the thing. That's on a purchase. I have mastered over 28 years of doing over a couple $1 billion in no-cost refis where I pay all the closing costs. So let's use the example that you got the $800,000 loan at 6 3/4, and you can do a no-cost refi 6 months later. Okay, so if that was the case, let's just go back to 9/1/2024 as a closing date. So let's say you made 6 payments. You now owe $796. So we're going to lower the loan amount to $796 because we're doing a no-cost refi. So that if you could get on $796 in Virginia a credit from the lender to cover your closing costs, you would need a credit of about $4,500 roughly. So let's make that assumption that you can get a credit that covers that 6 months after you've purchased. In this example, it's $158 difference. You might say, and a pet peeve of mine is people say, oh, I don't want to go back 6 months or I don't want to go back 2 years. You never go backwards if it's a no cost and the interest rate is lower unless you choose to. Okay. And I'm going to go through this. So in this example, you've made 6 payments. If you paid $32 to the principal, the loan would pay off in the exact same time frame, 354 months. The lender also might let you set up the amortization at 29 years or whatever the case may be. But here's your power move. If you apply the $158, you now went from having 29 and a half years left, now down to 27.42. You saved essentially 15 payments by doing a no-cost refi 6 months after you did your purchase. Let's, pet peeve here, right? People say, oh, I've paid on my loan 2 years, right? So let's say it's 2 years. Made 24 payments, right? Now the balance is 783. So we're going to change that to 783. 6.5. Now the payment difference is $240 per month. If you pay $122 of the $240, loan pays off in the exact same time frame, right? 336 payments. Again, you learned the power move, pay the same amount, pays off in 315. You save 21 payments. Here's the thing. Anytime that you can get a lower interest rate, it's going to save you money if you can do it at no closing cost. Now, here's the thing. There are people out there that will say, oh, it's not a no closing cost because when you get a credit from the lender, you're taking a higher interest rate. The fact is if you're at 6 3/4 and you can get 6.5 and not come out of pocket with any money, I look at it as a no cost, right? Here, the if in fact you pay the same amount of money, you pay the loan off quicker. Okay. If you make the minimum payments, you would have to then take the money that you saved for 28 years, tell me what you did with it, how you invested it, and then subtract off the 2 extra years on the end. So no matter what the scenario is, you have the option to do what you want with the money. You're saving the money. If you choose to buy a new car, pay off a debt, things of that nature, you're still using that money to your advantage and you're not going backwards. So, systematically understanding amortization, you never hear this, but you need to listen. The fact to understand that a lower interest rate loan pays more money to principal in the earlier years of the loan than a higher interest rate matters. Because, like I used that example of the $2,000, and it should save $166, they take 30 some dollars of that and it's going toward your equity. So, whether it's 1 year, 3 year, 5 years, your principal will be less by having a lower interest rate. So, I can't stress enough to one, find a professional that does both purchase and no cost refis, that truly understands the amortization. I have had clients, Freddie, Fannie, Federal Reserve, Treasury, economists that embrace the no cost refi and use the bank's money to chase down their interest rate. Yes, it's rolled into the interest rate, but each time they're saving money. You start at 6 3/4 and get a no cost at 6.5. But if you could have paid the money to get 6 3/8, then you have to recoup it. You don't have to worry about the recoup time and you just take the savings, makes life easy. And then if 6 months later I'm at 6%, you'll be happy you didn't pay for the 6 3/8. It's all about making smart choices and understanding that amortization schedule. Those Freddie, Fannie, Federal Reserve clients, I've had some of them do over 10 no cost refis. They went from 8.5 back in the late 90s all the way down to 1.99 during the COVID years. Many of them have their homes paid off. They paid the higher amount each time they got a lower interest rate. It's just smart to do. But you have to understand how amortization works. Lower rate compounds that savings, not only just by the monthly savings, but also in higher principal payments in the earlier years of the loan. My name is Kevin Retcher, owner of First Meridian Mortgage. If you ever want an amortization done on your loan, an analysis done, I'm happy to do so. Whether you're in my states or not, I'm licensed in Virginia, Maryland, DC. I have 32 other states covered with other broker owners I can refer you to. I'm happy to do your math. 703-799-5626. As a Marine, I'm happy to serve you. To all the Marines out there, you know what I'm going to say. Semper Fi. I'll talk to you soon.